Hey, folks, before we get started today, I want to say thank you for being a loyal listener of the Wiser Roundtable. In our weekly meeting this week, our marketing brand manager, Dana, came in with some great news that we are in a top 700 spot of podcast right now. And I didn't realize this, there's over 400,000 podcasts out there that people can listen to. And thanks for choosing us. To help us even grow more, I'd like to ask you for a favor. If you could go on and review us or give us a 5-star rating on iTunes, Spotify, Google, Stitcher, or however you're listening to this podcast, we would appreciate it. Again, thanks for listening. We have a great time putting this together each week, and hope you enjoy this episode. Welcome to the Wiser Wealth Management Roundtable, where we believe the best financial advice should always be conflict-free. I'm your host, Casey Smith, guiding you to financial freedom are my co-hosts, Brad Lyons and Matthews Barnett. Hey, guys.
Hi, Casey. How's it going?
It's going great. This episode, we're going to talk about constructing portfolios using exchange-traded funds or ETFs. We have been in the ETF space for quite a while. In 2004, I started using ETFs in our models, mostly smaller-sized accounts, to help us kind of scale, help everyone across the wealth management spectrum. And then we realized just how efficient the ETFs were becoming, and we started building entire portfolios with ETFs. I think in 2004, there may have been only 200 ETFs available to choose from. Now we've got thousands of different ETFs to choose from. But it was a fun ride. There was a guy here, Kyle Waller, and I. Kyle Waller was a research analyst for me at the time. We just started writing about ETFs. Not naively at the time, I said, we're going to know everything about every ETF ever created. And I quickly realized after about a year that was never going to happen because, we're creating 4 or 5 a day. But it was a fun time period for us because we were writing for a prominent website about ETFs that led to speaking engagements all over the world. We went ETF.com. Used to be called Inside ETFs. It was the name of the company. Now it's the name of the conference in Florida. We did that for about 4 years in a row. The first ETF conference in Amsterdam. Kyle and I taught a master's class in Singapore about ETFs at the time. Went to Shanghai shortly after that to talk about ETFs and what they could bring to China. It was a good time period. ETF Database even named me that year as one of the top 25 pioneers in the usage of ETFs in the country. I didn't even know I even got that. They even sent me an email. Just a trader in New York said, "Hey, congratulations." And I said, "For what?" They're like, "You're named top 25 in the country." So that's really cool. Now more and more people use ETFs. It was amazing to me back then how many firms didn't understand it. They were calling them derivatives and all that. So in our last podcast, we had a great segment on what is an ETF. This is part 2 to that on why would we use them? Why do we build portfolios using ETFs instead of mutual funds? Even index mutual funds, we prefer the ETFs. But that's enough about our background on our history. Brad, you come here you joined us from pension management world, brought a wealth of knowledge of ETFs to the table as well. What do you see is why we want to have ETFs in portfolios?
Well, Casey, this is really a great topic, and investors who are listening to us, I hope, can take at least one thing from this podcast and utilize it in their portfolio to improve its circumstance. ETFs are highly versatile investments, which allows the investor to pick and choose the usage of each and individual ETF in order to create a portfolio that better reflects their values and their objectives. We use them in a couple different ways. that's pretty standard in the industry, but there's some unique aspects to ETFs that can be used in a portfolio, again, to reflect how you want to be as an investor and what you want to achieve with your investments. When we're looking at our clients' portfolios and we're trying to relate that to the financial plan, which has brought out their individual objectives that they want to achieve, either retirement or college planning or an objective such as buying a second home of some sort maybe in the future, we look at using ETFs in order to cover broad asset class exposure and creating strategic portfolios. Now, a strategic portfolio is a long-term asset allocation based on risk and return profiles of the ETFs that represent the index that they're investing in. The one you'll quite often hear about is the 60-40 portfolio, where the investor is choosing to allocate 60% of their assets in equities and 40% in bonds. Those equities can be diversified across domestic landscape, international landscape, large cap, mid cap, small cap, etc. International, which would include developed markets, emerging markets, and then on the bond side, a broad diversified portfolio of fixed income investments to provide income and to mitigate risks of investing in equities. So that's basically what a strategic portfolio is. It provides access to these broad asset classes. Now, using ETFs in this space is very highly efficient. It gives the investor the opportunity to have access in each asset class at a very low cost and a very highly liquid investment, because when asset classes increase in value, which is what we hope occurs, you lose sight of the target, you move away from that, so you rebalance from time to time. That's one of the things that we do here as investment managers, is we constantly are looking at the relationship percentages between equities and fixed incomes in order to maintain that balance of 60-40 in this case. So if ETFs gives us the opportunity to easily and at a very low cost rebalance a portfolio back to a 60-40 in this example in order to maintain that risk-reward relationship. And Casey, I think in the last rebalance we looked at in 2020, it increased our return by, 300 basis points on an annualized basis?
Yeah, and basis points is just a conversion of percentage. So 300 would be 3%, just for those people who don't follow BIPs. Remember when I was in college?
There's a lot of jargon in this business.
I remember when I was in college, guest speakers would come into our finance class and talk about BIPs. And I'm like, what is he talking about? And I would add to strategic too that in a 60-40 portfolio, you're going to end up with 6,700 stocks and about 12,000 bonds, especially those using Vanguard ETFs. They're very diversified. So you're not really you're not trying to get rich overnight, which I don't think any investor should have that philosophy. But you're definitely going to be able to keep up with the long-term trends of the market in a very efficient manner.
And that's the beauty of using ETFs, is that you're getting full participation in the marketplace every day in every asset class that you choose. So,
And the liquidity part, I think people confuse that because they think, we got to have liquidity so we can be out of the market and back into the market if something were to happen. And that's not what it's for. I mean, people use it for day trading, obviously. They use ETFs. But when I think about liquidity in ETF, that means I can move out at a precise time to rebalance into something else at a precise time, not to be in and out based off of emotion and feelings.
Precisely. And the liquidity factor also brings to how quickly can you get out of the market without moving the price point of that security. So ETFs are great at that. And some ETFs are more liquid than others. And you'll want to look at liquidity as a factor along with price and along with index coverage when you're choosing an ETF.
You mentioned rebalancing. There's also the option, and another big part of ETFs besides the low cost and diversification is just tax management and tax efficiency of ETFs. Because they are broadly diversified, but you also have the option to do what's called wash sales with ETFs. Where you can buy a similar but not identical fund and then replace that when the market's down, take your losses on that sell, and then reinvest it back in the market 30 days later. So it provides you a lot of options with some tax efficiency there, some tax loss harvesting, as well as, like I said, tax efficiency throughout the day when you're able to trade those funds.
So we've described strategic portfolios, I think, fairly well. It's 60-40 allocation, or 20-80, or 100% stock even. That could be a strategic allocation. 90-10 is probably a little better than that. But let's talk about other ways that other people are using ETFs. We do strategic allocations here. I think that makes the most sense over the long term.
Over the long term, it does.
But other firms also use tactical allocations. Would you go into that a little bit?
Tactical allocations are really a strategic allocation with it at its core, but then utilizing an ETF to gain additional representation and investment in either an asset class, a style of investing, and in a region to invest in, for example, or even in different market caps, large cap, mid cap, and small cap. So based upon the investment philosophy of the firm and based upon the economy, and the chief investment officer of a firm may say, look, we think that small caps are likely to do well in this environment, for example. So we want to take a portion of the portfolio and add it to our existing small cap allocation to provide a greater return potential in the future by overweighting that asset class. Conversely, if you think that there's a certain asset class that might do poorly in this market environment or particular market environment, you may lessen the amount that you have invested in that asset class and put it elsewhere. That's a tactical allocation. They tend to be a shorter term in nature, so it may be somewhere between 18 to 24 to 36 months, where you believe that different market conditions are presenting to you as an investor opportunities that you may want to take advantage of. ETFs are a great way to do that.
You mentioned themes. There's a lot of thematic ETFs that are popular right now, just trying to get ahead of the curve and kind of see what the future is about with, innovation ETFs, or clean energy is pretty popular right now. So you see a lot of that in the news right now.
And that's a great way to isolate, an investor's actual values in investing these days. You may have a particular interest or a bias in a certain industry or a certain type of company. And ETFs, which is an index created around a certain theme or factor, is a great way to express your interest in investing.
So we have strategic, which is core holdings, not evenly, but strategically placed out amongst large, mid, small, foreign, emerging markets, right? And then a core bond holding. That's what I would consider a pretty strategic portfolio. A tactical allocation is going to overweight or underweight any of those categories that I just mentioned. And then we have a core satellite strategy in building portfolios. Tell me a little bit what a person's thinking on a core satellite and how that's built.
These are very interesting portfolios. It allows the investor to take advantage of both aspects of a core portfolio based upon long-term risk-return measures and based upon your objectives. So that part of your portfolio is dedicated to your long-term objectives. A portion of your portfolio can be then carved out, let's say, and invested in different themes or different industries or different sectors that you think that might do well or that you have expressed you have an interest in. It could be anything outside the core of the portfolio, whereas tactical, as Casey mentioned, is emphasizing asset classes within the core portfolio by underweighting and overweighting them. The satellite of a core and satellite strategy is something completely different from the core portfolio. A satellite position might be investing in a particular sector, medicine, pharmacology, automation, electric vehicles, green energy, anything of that nature that you want to isolate and invest money into and try and get what's called alpha in your portfolio. Now, alpha is greater than the market return, getting more than what the market provides opportunity. So a core and satellite portfolio is maintaining a core portfolio and then utilizing ETFs to isolate different sectors of the marketplace and the economy to invest in those uniquely and separately. That money can be, I won't say traded, but when you invest in those and you realize your gain, you can sell it off and put it into another satellite position or return it back to the core if there are no other opportunities available to you. So it can be industries and sectors. It can be different regions or countries. If you think a particular country is going to outperform other countries, and it can be different themes or factors. A factor might be dividend investing. You might think that you want to invest in companies that pay higher than normal or average dividend. Well, there are indexes that have isolated companies that do this, that have the characteristics of paying high dividend, put it together in an index, and then created an ETF around that. So any theme or factor can be utilized.
So another strategy that I guess it falls a little bit under tactical would be sector rotation. And we see this quite often where they take the U.S. sectors, energy, transportation, retail, right? So you take these major U.S. sectors, and the rest of the portfolio is pretty bland. So it's foreign, it's emerging markets, it's your standard bond portfolios. But the manager is trying to select which sector of the U.S. economy is going to outperform for this year. It's a 12-month outlook. And they will try to rotate that or overweight those sectors that they feel are going to outperform the S&P 500 as a whole. That used to be really popular. I don't see that as much, but maybe I'm not looking for it.
It's been tough to beat the U.S. recently.
But that was something that was very common when ETFs first came out. They would use those for sector rotation strategies. Another one that I think we'll talk about, decide on our list, we'll go rogue here for a second, is the smart beta funds, right? The factor funds. So you have ETFs with certain factors about them. We've had a factor in our portfolio for a couple of years now that's based on quality. So we take part of the S&P 500 and we're saying, okay, in times of uncertainty, we want to make sure that we own the best, well-managed companies, right? The at least with the best balance sheets. That the companies, if there's big surprises, that they have enough fuel in their coffers to get through whatever the situation is. Companies like Coca-Cola, Apple, right? That would be in the quality index. But you could also buy other factors that only buy like a growth factor or a value factor, or it could be, and those are styles as well.
Right.
I'm trying to think of other popular factor-based funds that are out there. Again, as I opened up in the podcast, there's thousands of ETFs now. I'm not interested in probably 90% of them, quite honestly.
Well, it used to be, and it's thought of that ETFs are strictly a passive investment. Okay, but through the use of creating factors, you're really isolating certain companies within a broader market, and that can be even kind of thought of as it's actively selecting companies based upon criteria that the index has created in order to find a basket of securities to invest in.
With no fund manager. That's important to point out, that these factors are computer-based. They're not...
Right.
They're not...
It's a criteria-based,
it's
a screen.
Manager. Right.
Mm-hmm. Well, you look at ones that have done well recently are just entertainment industry and retail, airlines, cruise lines, stuff like that. Obviously tanked back last year in March, and over the last few months when things are opening up a little bit more, they've obviously done really well. So that's kind of something I think people are betting on. The Jets ETF was a big one that really turned around. People kind of betting on things turning around a little bit.
But yeah, those are style ETFs that you mentioned. What I'm talking about is the factor funds that are rebalancing every quarter. It's like in the quality fund, QUAL, every single quarter, it could be a different company that shows up there based on certain criteria. So those have been a growing trend. I'll also point out that the ETF industry is not necessarily your friend. The ETF world, they're developing products based off of what the market is asking for. Great example was when we had the BP oil spill many years ago. They came out with a high yield bond fund with no oil stocks. Right? Did the market, at the time is like, oh yeah, I can see a broker now. Oh yeah, we've moved your money out of that. We put your money in something that doesn't have any oil stocks in it. And in the end, oil stocks did fine. It took a little while, less than a year actually, for a lot of those prices to recover. So you have to maintain a long-term focus and realize that what's being advertised to you may turn your heartstrings, or might turn the fear, might try to calm your fear of investing for some reason. But in the end, it's probably a dead end. It's probably a dead end road that you're going down with a lot of these ETFs that are created. We were trying to create a Bitcoin ETF. We haven't done it yet. There is a way to buy a Bitcoin through an ETF, but it costs you 20% premium. So as soon as that comes to market, everybody's going to want to be in that, I'm sure.
It's how they market it. Everybody's trying to find the new things. I
remember during the financial crisis, there were indexes X financials. And when you think about it, it's probably a good time to pick up some financials, right? It would look a good investment now for sure.
But with computer-aided index creation, they essentially create an index of anything you want, and then create an ETF around it, utilizing that index, and then present it to the marketplace in response to some desire for that sort of product or demand for that product from the investing consumer. So
yeah, we have to be really careful of data mining, meaning that you create a product and you look back and say, well, during this time it did great. Well, that's no guarantee that the future is going to be better. What I do know is this. So the S&P produces a report every year of active fund managers versus the S&P 500, right? I do know every single year or every 6 months when that's produced that over the long term, you have nearly a 98% chance of beating the S&P 500 beating the active managers with the S&P 500 over like a 20-year time span. So if we're all focused for the rest of our lives, most of us have 20 plus years, or should assume we have 20 plus years, even 10 years, you're still up by owning just the S&P 500, which is why I like it. You're not taking a value bet or a growth bet. You're not taking a bet on sectors and hope that you're right. You're basically buying the asset class that no one else can compete with over the long term.
And I think we mentioned this in the last podcast where we talked about what is an ETF, but by investing in the broad asset class, you're guaranteed to be invested in the best performing sector of the market at any given time in that marketplace. So if energy, like this year, has done very, very well, last year it did very poorly, but by investing in the broad asset class of the S&P 500, which contains energy, you're invested by default in that sector.
Yeah. Okay. Then you just diversify away from that. So you own small cap stocks, which have done well recently. You may add mid cap stocks. You might add foreign to the portfolio. I think everyone should have foreign in a portfolio. To what percentage, we have to determine that based on risk tolerance and what we think the dollar is going to do, because that's your biggest risk is currency. But
there are over half the investment opportunities that we have available to us exist outside the borders of the United States. So if we want to say that we want to be broad, diversified investors, by default, we need to have money invested beyond the borders of our country. So, and there are just a tremendous number of opportunities available outside the U.S., and to not take advantage of them would do us harm.
Yeah. I think something else we should talk about too is when you look at these strategies, whether it be tactical, core satellite, sector rotation, strategic, you need to compare it to a benchmark. I saw recently a fund that was advertised, and it said we beat the S&P 500 for like the last 5 years. What's interesting is it was a growth fund. So the growth, we talked about this in prior podcasts, value, your companies have been beat up, right? Probably pay a dividend, but they've been beat up, undervalued companies. Then you have growth companies. These are mostly your technology, your NASDAQ, almost like stocks. Growth has been outpacing value at a tremendous rate. So that means that S&P by itself has its rate of return. Then you have value, which is underperforming inside the S&P, and you have growth, which is greatly outperforming the S&P. So what this company did was they said, we beat the S&P over the last 5 years, but they own all growth funds. So they basically just only invest in companies that are rapidly growing and the prices have gone up. Basically all the companies that carried us through the COVID period, right? So when you look at performance of these asset classes, you really can't look at that marketing. You almost have to do comparisons to yourself. And I think when you build a portfolio, you should look at the entire world. This is how we do our benchmarks. So if I just bought an index that had the entire world in it, and then I bought a bond index. So if my portfolio is 60 stock, 40 bonds, the 60 stock would get compared to the entire world, right, in its performance, and the bonds would get compared to the bond aggregate. Really, you could probably do that with 2 ETFs. Create your own benchmark and say, based on this portfolio I'm looking at and based on this benchmark, which is done better. Amazingly, the basic core models generally outperform all the crazy ins and outs and rotations and all that stuff that's happening.
Yeah, the comparison, to put it in other words, it needs to be apples to apples. So you need to be comparing a like index to the portfolio that you're invested in to see whether or not you as an investor, or if you've hired an advisor, is adding any value for the fees that you're paying that investor, that advisor. So by using an apples to apples comparison, you're getting a true comparison of how well you're doing, other than if you had simply invested in the benchmark itself.
Right. Well, we could have a whole podcast on the value of a financial advisor. The value of the financial advisors should not be just based on a portfolio.
Well, no, of course not.
It's based on, it's really, I tell our clients, our fees here are 75% planning, 25% portfolio management. Because if you're using low-cost core index funds, you shouldn't have to do a whole lot of tinkering. We monitor these things weekly. We make changes when we have to, faster than what they would do on their own for sure. But the value of an advisor is more along the lines of planning, staying the course, guiding a person over all things financial, not just the portfolio. But there are many firms that only put their value in managing the assets, and that's the only service they're providing is managing the assets. And there, I would say you'd have a hard case as to why you would pay someone just to manage assets, and that's it.
You hear a lot of people say, well, how'd y'all do last year? Or how'd your portfolios do? It's not based on that. There'll be good years and there'll be bad years. So if they're hanging their shingle on the fact that they outperform the benchmark, it really depends on the financial plan and are they still reaching their goals is kind of the first point that's important.
Absolutely. Keeping people on the railroad tracks when it seems like a good time to derail is really the value of the advisor. But going back to your point earlier, we rebalanced our portfolios during the COVID sell-off near the bottom. We rebalanced again at the top. It added a 3% rate of return. There's some advisor management value that we built there, probably covered 3+ years of our fees just by doing that one move. But that is that's more quality portfolio management versus these sector rotations, because you're going to be wrong at some point. That's the problem I have with sector rotation, or sometimes even tactical, is that you could be wrong, and then all of a sudden, you're running a race, and the pace setter is way up ahead of you, and you're going to have to take more risk to figure out how to catch up with the average, right? Average being the S&P. So it's you just have to be careful. Anybody can window dress performance to be the best, to make it look like they're the best. But it's hard to be the best in active management, for sure. I think we got on a soapbox there. Oops.
That's okay.
But yeah, getting back on our agenda, I think Matthew's talked about tax management of ETFs. We talked about that in the last podcast as well. Brad, why don't you talk a little bit about transition management?
Well, transition management is used either by, it's used when there is a transition of the portfolio. For example, if you're changing platforms from one to another, or if you're changing advisors from one to another, or if you're an institution who's changing consultants from one to another, what the asset owner will do in that instance is to liquidate the securities that they own, place them into an ETF during the transition period to maintain market exposure, yet search for a new, advisor, or it can be used during a period which you as an investor have selected securities, individual stocks, for example. You've realized the gains that you believe were available to you in those securities. You don't really see anything in the horizon right now due to valuations. So you could harvest those gains by liquidating those securities, placing them into an ETF to maintain market exposure while you continue to search for other securities. So the portfolio is basically in a transition, and you're utilizing an ETF to maintain market exposure during that period.
Yeah, and I think that was really the original intent of SPY when it was created, was it gives asset managers a place to park assets until they decide which stocks they wanted to buy, and it just kind of carried on from there, which is pretty cool. To be where we are today and look at the massive inflows for I think it's been at least a decade now, more assets have flown into ETFs than mutual funds. So much so that at the ETF conferences we go to, the landscape has changed with all the sponsors. Sponsors used to be Vanguard and iShares, BlackRock's iShares, and they still are the key sponsors. But now you're starting to see Franklin Templeton, you're starting to see Northwest Mutual and or Northern Trust, and all these different companies pop up that I kind of look at it. I'm like, look, I'm not going to play in your space. Your products are expensive, but they are making some headway. So it's very interesting to see that. But yeah, I think for those DIYers that are listening, you got to stick to core asset classes that are inexpensive and have tight spreads, meaning you look at the bid and the ask, and if it's a one penny, that's probably a good fund for you to stick with. And as long as it has $100 million in assets, you probably don't have a threat of it shutting down. Outside of that, you have to be careful in how you trade the ETF and understand what's inside it. But we could go on for hours and hours talking about this. We'll probably need to have a whole segment on how to trade ETFs, maybe not for our clients, but certainly for other professionals. I meet so many professionals that still use market orders for ETFs, which
at the open.
Yeah, at the open. Yeah, I just kind of chuckled to myself, and even talking to a former head of trading at TD Ameritrade. This has been a couple of years ago. He was telling me that they would get really large market orders. Like there wasn't enough liquidity in the system to cover those, and it was done by firms with billions of dollars in assets. So obviously, even professionals are still learning about ETFs, not just consumers. All right, guys, great conversation, and we'll see you next week.
Wiser Wealth Management Incorporated is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.